There are reasons why stocks and dividend investing can be better than real estate investing for expats. And I'm not saying that that dividend investing is superior to real estate in all ways. Both dividends, stock investing, and rental properties have their own advantages, and I'll cover in a separate video why rental properties might be best for you. But in this video, I'm going to look more at why dividend investing should be given consideration if you are an expat. Now, I'm not a financial advisor here. Everyone's going to have different goals. They will have different risk tolerances. They will have different time horizons for their investments. So what you want to do for your situation is going to be different to the next guy. But in this video, I'm going to talk about some of the reasons why dividend investing might be better for you if you are an expat. My name's Aaron, I'm from offshore in Asia. So if you're interested in moving out to Asia, doing business, investing in Asia, we can help you to make these things happen. Head over to our website, offshoreinasia.com, if you want to learn more about that. So on to the video now. One of the main reasons why dividend investing can be better than property for expats is that it is very easy to maintain, especially when you are living abroad to the country that your investments are in. If you're a dividend investor, all you really have to do as far as the admin burden goes is file away a dividend statement when that comes in. That's pretty easy. Just chuck your PDF in your folder for your tax return and you're done. If you're buying and selling stocks, you may need to keep track of the balance of the number of units you hold for capital gains tax purposes. But apart from that, it's pretty straightforward, especially when you compare it to property, when you have to track your income, track all of your expenses, and perhaps even manage it as well while you're overseas. Managing a property from overseas can be a massive headache. You have to deal with vacancy rates, you have to deal with issues with tenants, you have to plan maintenance. When something breaks down, you might have to get on an international phone call to organize a tradesman to go out and fix it. It can be costly, it can be a pain, you could be getting calls in the middle of the night if you're in a different time zone. It's pretty good when things are running smoothly, but if you have ever owned property, you will know that it does not run smoothly all the time. That is guaranteed. With shares, there is no headache. You don't have to worry about maintaining things that break, tenants that move out, organizing new tenants and doing home opens. There's none of that with shares. All you do is you buy it, you stick your documents in the bottom drawer, and then you watch the dividends roll in. That's it. Now, if you have become a non-resident in your home country, the home country that you own shares or stocks in, and you moved to another country, and you don't hold other assets back in your home country, there's a good chance there that you won't need to lodge a tax return. Of course, this is going to be different for every country. It's going to be different for every taxpayer. But there is a chance there that you may not have to lodge a tax return in your home country, depending on the kinds of income that you earn. And if you did have to lodge a tax return, it would be pretty straightforward. Now, with property, you are going to have to lodge a tax return. This is real property sitting in your country. It has permanent establishment there. They are going to want to tax it there. They will tax it there. It is taxable, and you are going to have to file your tax returns regardless of whether you're living there as a resident or overseas as a non-resident. So there's a higher admin burden with holding property compared to holding shares as a non-resident. All in all, there's just a lot less work required from you, a lot less attention required from you when you hold a stock portfolio compared to having your money in rental property. And that can be a big thing, a massive advantage if you're living overseas. The next reason why dividend investing can be better than rental real estate investing for an expat is that the yields can be higher. So now I'm going to show you a screenshot of a particular ETF in my home country, Australia. I'm not saying this is something you should buy. I'm just showing you that this is something that is available and showing you that the yields can be quite attractive. So let's have a look. So what we're seeing here is the Vanguard Australian Shares High Yield ETF. The ticker on the ASX is VHY. And we can see here that it has an equity dividend yield of 5.2%. That's your after-tax yield. Keeping in mind that when I say after tax, I'm only talking about corporate tax. So if you are on a higher tax rate than the corporate tax rate, which is 30% in Australia, that means you may have a shortfall you have to pick up. But then again, if you're a non-resident, you may just forego that imputation credit, that franking credit, and be able to keep that net yield, that 5.2%, as cash in your pocket. Let's have a look at another one here. This is the Perennial Income Generator Fund. This is an actively managed fund. The ticker code on the ASX for this is EIGA. And here we can see this one pays out a monthly dividend, so this might be attractive to people who want to spread out their cash flow a little bit. You can use this to essentially create a pre-retirement and early retirement pension fund and get a monthly payout from that. And as we can see here, it has a gross yield, including franking credits, which is your corporate tax, of 9.2%. And after you take out the corporate tax with this particular ETF, you're left with 6.9%, which is pretty good. And now let's compare that to average property yields in Australia. So here we have a chart and we can see that all houses, which generally get a lower yield than units in Australia, they are getting around 3.5 or a little bit higher, 3.6, 3.7%. And units, the pink line up the top, they are getting around, that'd be about 4.9%, I would say. Now that sounds pretty good on the face of it, but what you have to keep in mind here, these are the gross yields. So this is the money that you receive before expenses. And then you have to take out your property management fees. You have to take out repairs and maintenance, capital expenditure. There might be land tax, there might be strata fees. Then you have to pay income tax on that. And after you factor all this stuff in, you're not really left with much, and certainly left with a lot less when you compare it to those two examples that I showed of the ETFs where they had after-tax earnings rates of 5.2 and 6.9%. Now, fair enough, it's not quite an apples to apples comparison here. Those two ETFs I showed you, they are income dividend funds, so they are focused on creating income. So generally they have a higher yield than some other more broadly based index funds would have. And I compared that to property prices across capital cities in Australia. But you have to make note as well that generally in the capital cities, especially in the big cities like Sydney and Melbourne, yields are generally lower because property prices are higher. You do generally get higher yields if you go out into the regional areas. The regional cities normally will get you a better rental yield. But this will give you a pretty good idea of how the yields can stand comparing an average capital city property to an ETF that you can just go buy on the ACX very easily. Now, the last reason that I'll cover here why dividend investing can be better than property investing for expats is that dividends and stocks in general can have better tax treatment. For example, in Australia, capital gains tax on real property is taxed differently to that of shares, provided that you pay an exit tax when you become a non-resident in the country. You can pay your tax and then you can be out of the system as far as capital gains tax goes. But if you've got property, you're still on the hook. Even if you're a non-resident, they'll want you to pay capital gains in Australia. You can't escape this by moving overseas, because if you sell a property as a non-resident, the buyer of your property is obligated to withhold 12.5% of the whole proceeds of the purchase and then submit that to the ATO, the tax office, on your behalf. Important to note that that's not a final tax, it just is an installment towards your capital gains, but still that is quite a large chunk of money. If you have, say, $1 million property, that's 125 grand that's going to the ATO. The next thing is that if you own rental property and you're renting it out in Australia as a non-resident, you'll have to pay 32.5% non-resident tax rates on your income off the first dollar. You basically lost your tax-free threshold and a bit more. Now with dividends, if you've got a franked dividend, you may just lose your franking credit, then you're on your way. If you have an unfranked dividend and you're living in a country that has a tax treaty with Australia, there's a good chance that the withholding rate on that may be reduced to 15%. And then depending on how the country that you're living in taxes dividends, it could even be tax-free on the other side. So there are opportunities there to do some pretty good tax planning around shares, not just for the dividends, but also for the capital gains side, that you just cannot do with property. There is a lot less flexibility when it comes to property being a non-resident, in Australia anyway. And if you have left your country and you've become a non-resident there, it can be a lot easier, a lot more beneficial, a lot more flexible to move your investments around. Like if you've got a property, that's a big, piece of asset that has to be sold. It might take 3 months or longer to get a sale on it. If you have shares, you can pretty much sell it straight away. And you could move your money to, or your investments to, somewhere like Singapore, where they don't tax capital gains and they don't tax dividends in the hands of the shareholders. So there is a lot more that can be done to plan your tax and reduce your tax load if you are an expat and a non-resident back in your home country. If you are interested in learning more about investing, setting up a bank account and a brokerage account in Singapore, send us a message over on our website. We can help you to get started there. That's it for the video, guys. We'll wrap it up there. As I said at the top, I'm not saying here that shares are always superior to property. Property definitely has its advantages as well, but this video was very much about the reasons why shares can be better than property for tax purposes, for income generating purposes, and just for the headache of managing it from overseas. Now, if you're looking to learn more about any of this stuff, head over to our website, offshoreinasia.com. You can book in a consult call there. You can drop us an email via our contact form, and we can help you to get set up and living and investing and doing business in Asia. Thanks a lot for watching. We'll catch you later.